how the beta decoupling has worked, and Nifty 1SD trends also we have discussed multiple times in last week, and the last Friday also I have shown you how the levels of Nifty and Bank Nifty, what are the levels are being given, and yesterday it has obligated and given you that uptrend breakout, and today is holiday, and I'm expecting, based on the SGX data, I'm expecting that tomorrow may be a good day for the Nifty if overnight no bad events triggered internationally. Then you may expect good achievement in the Nifty future this week also, because yesterday it has given the uptrend breakout and moved to certain extent, and today's SGX data suggests that it has well moved above 0.888 retracement. So you may get a good week. This week may be a good success for 1SD trend forecast. So today primarily I will be discussing about the strategic investment planning for the small traders. So whenever we plan for one investment, or when we do some specific investment, based on our risk appetite, based on our objective of the fund requirement, we will be doing that investment. So it is nothing to do with the trading, and earlier days there was no such opportunity was present, but from the past 5 to 6 years, if you can say, in the recent past, many new instruments has come into the market which can give you a great freedom of investment, and you can get very good profit from that also. So today the things what I am going to describe, it is a small planning, investment planning with respect to your investment objective. Very conservative planning I am going to describe in front of you, and I will be taking the help of some mutual funds and the ETFs, exchange traded funds. So these two instruments I will be taking for my planning, and I will demonstrate that how this planning worked. So whenever we go for any investment planning, or whenever you go to your investment advisor who is giving you the investment planning, what are the things they will ask you? So they will say that what is the investment objective or investment goal? What is the goal of your investment, or what is the objective of your investment? So you can say that 5 years ahead the line, I want some fund for my son's education, or my daughter's marriage, or build a house, to buy a car, or retirement offer. All these things they will ask you. That is your goal or objective you have to define there. Then your age is also second criteria. They will ask you which age basket you fall in. So your earning age, if it is there, then it is good. And then they may ask you about your risk appetite on the market. So how much risk you wish to carry on this particular aspect. So that also maybe they will asking you. And based on this objective, based on your goal and objective, based on your age, based on your capital requirement, they may suggest you different plans, but most of those plans are not unbiased plans. Many of those plans are biased, and many of those plans, though they will talk so many things with you, they will take lot of informations from you. However, the basic objective of their planning will be that if how much more brokerage they can get from that your deal. So that is what they used to fix up. So that is a unethical practice of investment planning. But here I will be just describing a very small investment planning which you can able to do yourself without the help of any kind of advisor. You do not require any advisor to implement this particular planning. So you can make this planning as a conservative planning. You can also make this same plan as a moderate planning, you can also make this plan as a little riskier planning. So without changing its component, you can change these plans to different criteria of your risk. Means if you are a conservative or moderate risk taker or a high risk taker, based on that you can able to fix it up. However, the basic idea of this particular planning is we need to understand the market well. It is a money market where you are going to put, and it is a very simple method. So investment planning, whenever this term comes in front of you, you think that it is a very toughest thing and this is only one expert can able to do. It is not true. You yourself can able to do this investment planning. So I am talking about a scenario wherein suppose if you have 1 lakh rupees money in your hand, which is a surplus money, and this money having the capacity to earn 8% per annum interest risklessly if you put it in any liquid mutual fund or if you put it in a FD. But I will prefer the liquid mutual fund. The best part of this liquid mutual fund is that there is no penalty clause associated with that. You put the money used to grow. Whenever you wish to come out from that particular instrument, so today before 2 o'clock if you redeem that things, next day by 10 o'clock you get the fund in your account. So today before 2 o'clock if you give a redemption request, next day by 10 o'clock that money will be available in your account. So that has a flexibility. So this also earns you the similar, almost equal to same interest rate as your FDs are preferring. So normally they put this money in the CDs like certificate of deposits, treasury bills, 91 days treasury bills, and these are called as the short-term funds. So many fund houses are having this liquid mutual funds. I will not be recommending any fund houses. However, you can have a web search, you can get many liquid fund houses. And here, one thing I wish to tell you about the market. Whenever we observe the market in the technical terms, besides your moving average, oscillators or trend parameters, whatever you follow. So besides these trend parameters, market follows one cycle. So each uptrend or a downtrend in a market, based on the Fibonacci study or based on the Elliott study, it follows a cycle of 3, 5 and 7. So based on this is the things, this is the core of all these studies. You can say that each corrective wave in a Elliott wave, if you are a student of Elliott wave, you will be knowing that each corrective wave, the ABC wave is a 3 wave. Why not 4 wave? Why the Elliott has made it a 3 wave? So each correction is a 3 cycle. Whenever any correction happens, it is happen in a 3 cycle, and that corrective wave is not necessarily to be only downward movement, it may happen in the upward direction. So similar way, whenever he talk about a impulsive wave, he gives you a 5 wave structure. So any wave which is a 5 wave structure, so market, any trend sets, it move in the 3, 5, 7. Suppose if you are downtrend you are starting, then at one particular point your downtrend will have a 3 cycle, 5 cycle or 7 cycle. So 7 times or 7 loops it can go, and in between it can have some little of flip, it can give some technical bounce back and other things. But this is a normal historical prices. Once we observe, we will get a 3, 5, 7, sometimes 9 and 13 also used to come, but very rare. But 3, 5, 7 is very frequent things. So here I am saying about you have a conservative estimate, your money which has the capacity to earn 8%, if it gives you 2 or 3% more, it is very good, more than this 8%. So out of this, I am saying that every 5 to 10% of correction in the index, you invest in the ETF with a proportion of diversifying 20% of your capital. So you are starting with a 1 lakh capital, diversification of 20% you are doing in a conservative estimate, and based on that you are going to invest. So this is the basic theme of your investment, what I am telling. So I am just going to describe the same thing here. So you have to start with one base. So I am taking one base here from 2015 January. 1st January 2015, I have the capital of 1 lakh. So this capital of 1 lakh is being invested in a liquid fund with an interest of 8%. So it is having a capacity to earn 8%. It is in a liquid fund. So my aim is each 10% of 5 to 10% of correction in the index, I'll be liquidating 20% of my capital in liquid fund, and I'll be deploying that capital in the ETFs. So if I say that my base is starting from January, it is not the market high, not the market low. The day I start my investment, from that day itself I am just putting my base. So my base is 8,284. Maybe it has fallen down for 9,000, 10,000, I don't care, because this is the 8,240, 8,248. This is my base price from where I am going to start my planning. So here I'm just going for a 5%. So 5% in that means 400%, 400 point correction in the Nifty. I will liquidate 20% of my capital, which is 1 lakh. I'll take out 20,000 and put it in the ETFs, Nifty ETFs. Nifty ETFs, many of you will be knowing that whatever the Nifty value it will be trading on that. So suppose Nifty at 8,284 means it will be 828.4. So many Nifty ETFs are there. You have to look into a good ETF which has not eroded the base value. Like if any ETF, if the Nifty at 8,284, any ETF is trading above 8,284, that says that the management is very proactive and they are protecting those ETFs. Any ETF is trading 5 or 10% below this base value of 8,284. That says that they are poor in managing that ETF. So many ETFs you can get, Nifty ETFs. So just look into some good ETFs. So every 20%, 5% correction, I will be deploying 20% of my capital. That is the objective I set. So my objective, I should earn more than this 8% of the interest what I am supposed to earn in this particular money. More than that I should earn. So that should be my objective. So what I did here, if I look into this particular factor, only on the month of August, from January to August, I didn't get any chance. Month of August only, it has fallen down to 7,809. That time I got a chance to enter 20,000 rupees. So in this, you can say 7,809, 781 will be 1 unit if I am taking that things. So 25.6 units of ETF I could have bought. 8,248, from there my calculation started. And by this time of August 24, at 8% interest, this fund could have earned 5,128 rupees. This is the interest the fund could have earned by this point of time when the diversification happened. Post diversification, only 80,000 rupees is there, and this 20,000 is in the ETFs. So if I just look into this month of August, post I enter this trade, on the month of October, thus Nifty has bounced back and it has gone to 8,238 from where my base has started. So I am just exiting that. I'm just exiting that. It has not given me anything. Just it means it has not given me an opportunity to enter again another 20% deployment. Rather, my first 20% of deployment has yielded me 5% return in a time span of less than 1 month. Less than 1 month, my 20% of capital has rewarded me 5% of return, and I come out. Once I come out from there, so this is the money I earned, and by this time the remaining money would have earned an interest of 6,400. So with this I'm just carrying on. So I can say that after I exited these things, I earned in a very short duration of less than a month, I got this return, and again I redeployed my money into that liquid fund. Whatever the return I got, I am just putting it. I'm not taking this 1,094. I am taking only 20,000 again to my liquid fund. And based on this, again 9th November I am getting a chance. ETFs. So ETFs, once you enter to this ETFs, you must say that this 20,000 from where I am getting. So this 20,000 what you are getting, it is ETFs once you enter. This too also fund obligations has to happen in the next day, and as soon as you, if it is before 2:30, if you are entering, then in that day itself you just give a liquidation of 20,000 on your liquid fund, and next day 10 o'clock you are getting the fund, and this fund also you will be get debited next day. So you should have a buffer. You should not run a bank account with a zero balance. So money will come, money will go. By that time, whatever the 2 to 3 hours gap is there, that requirement you should be in a position to fulfill. So 9th November again I entered, because first tranche what I entered, I earned a good profit of 5% on my 20% of my capital. I come out and I entered it 9th November again. So post this my next entry for this thing will be 7,410, because I have entered at 7,800 level. Again for 5% correction in the Nifty I will be waiting, then I will enter for the next tranche, so which is falling at 7,410. So I'll be waiting for that. So at the end of year, 31st December, so what I'm carrying on by that 31st December. So whatever the interest I earned, that is along with the profit what I made in the first tranche of this thing. So I have in liquid funds 88,450, and I have carried 25.64 units of ETFs of Nifty. So Nifty ETF of 25.64 I got it. This is what my carry for the next year, 1st January 2016, and that too also the second tranche what I have entered at 7,800, it was at a very little profit. If I can able to liquidate it also, I am at a profit, but I am not liquidating because I am not gone to that 8,200 level. I am just waiting for the further correction. So 7,400 is my next entry, which has happened on 15th January. 15th January, it has fallen down to that 7,430 level. So that time again I am just 120 more thousand I am putting. My next entry will be 7030 Nifty. So, and before that, if it bounce back, I will be liquidating and coming out of that particular trade. So 15th January I have entered. Again it has given me one opportunity on 11th February. Further correction has happened. 7030 level I have expected. I have entered. And my next entry will be 6,678, which has not happened. So only 7030 happened. So that 7030 entry what I have made 3rd March 2016, the last tranche 7030 what I have entered, it has gone to 74 plus level, 7475 it is showing. So my entry was 7410 level, so I am exiting out of that on 3rd March and holding the remaining. And on 13th April I am getting another one exit at 7,800 and remaining I am holding. So if I just analyze this particular thing here, so this is 3rd March, March 3rd I exited, March 3rd I exited. If I'm just taking the view of this particular thing, 25th August I entered, my base I calculated 8284. I exited on 16th October, made some profit here. Again I made an entry 7,800, 9th November, January, again further entry, February, further entry, 3 cycles as over here, as I told you 357. So post 3 cycles one bounce has started. On 3rd March I have exited from this. On April 13th I exited these 2 investments what I made in the January, February. I'm exiting from that. So first investment is already closed, August and October. November investment is with me. If this is the thing I have done and I am just calculating how much profit my 20% of capital is made, another 20,000 worth of ETFs holding still is there. So I am saying that due to this activity of trading, I earned 3,285 rupees of ETF tradings. Now come back to that how much, because I have deployed these capitals, so I'll be losing some amount of interest. So interest loss on this capital, what is being deployed on the November month, it is having 657 till this last 13th April. And interest lost in this January and February is having 341 and 271. So total loss interest, this is the risk-free interest you could have earned if the money is not diversified into the ETFs. If you take into account, you have interest lost is 1270. However, the trades through ETFs earned 3285. So on 2000 rupees extra you are getting, and your capital 80,000, 88,000 you have carried from the last sequence, and this capital only 20,000 of in ETF is there. This is also in the base value. So you can say that the first entry what you have made it at 7,800, 7,800. Considering 7,800 you are now. So this 20,000 value is not eroded, it is at a base value. Nothing has eroded here. The interest what I have lost in this particular thing, that also I am taking from this particular profit of 3,285. So I can say you by this process, instead of 8,000, if I take this 2,000 as a profit in a very conservative estimate, instead of 8%, I have earned a profit of 10%. So 2% more profit I have calculated, having a very conservative approach of deploying only 1/5 of my capital on every 5% correction in the index in the ETFs. Definitely you will involve some brokerage in this ETF transactions also. It is equity brokerage. So brokerage is variable from every person to person. So this is what you have put in that. So if you talk about in the taxations and other things, that is different. Someone is having 1 rupee earning, his taxation is different. Someone is having 1 crore earning, his taxation is different. So I'm not talking about taxation. I'm just talking about focusing on a factor here. Yes, with a very conservative estimate, I have got on 10%. You could have enhanced that. See, 3 cycles are over in the downtrend. 3 deployments it has given. One is in November, another is in January, another is in the February. Post these prices are moving up. Instead of exiting at the first trends at the 3rd March, if you could have waited till 13th March, that 3 cycles are over. Now if this recoupling is happening, or this covering of this thing is happening, then let me go for this January level instead of February level. If you could have made 2 exits at January level, 5% more income you could have got. So instead of that 1,081, you could have earned some 2,160. Or if this cycles you estimate, the first phase instead of 20%, if you deploy only 10%, second phase you increase to 15%, third phase you increase to some 20%, then also your performance will be promising. Or in the last cycle, when the 3rd cycle is coming, 5th cycle is coming, or 7th cycle is coming, if you deploy a little bit more fund, that also can increase your profitability. So with an equal distribution of deployment, with one very stringent rule, whenever we recover that particular 5% to come out from that trade, with that particular conservative approach also, I have shown you that how it has earned 10% return on this thing also. You can do for Bank Nifty ETFs also. However, some of you can say me that, can I put in the stocks? No. So can I put it in the stocks? No. ETFs, once you put it, index is highly reliable in terms of stocks, because stocks are depend upon individual performance. However, this is having a no individual performance based on this gross performance. And whenever you put in the liquid, there is no brokerage. Whenever you deploy in the liquid, there is no entry load, no exit load, no brokerage also. So and brokerage is there if it is some of your financial advisor takes that order, then it is a little bit of brokerage you may have to pay. However, for these ETFs, you need to pay the equity brokerage, and each equity brokerage, whatever comes in terms of your things, that also you can able to recover if you have a little bit of flexibility in exiting the things instead of 5%. If I want to just wait for a 6%, because every 5% correction I have utilized it. So every 6 or 6.5% of growth I can exit it from there. If you have that kind of objective, then you can easily recover that brokerages and taxes also. So this is the one of a very typical and more conservative and more rational investment strategy. You can able to enhance that thing based on your risk appetite. Like if you are a good risk taker and you say that okay, from November onwards correction started, January again I entered, February is the third cycle, so let me deploy something more here. So instead of having a equal proportion, that also can enhance if your risk you are increasing. Or one first leg of correction, you are instead of 20%, you are just putting 10%. And second leg of correction, you are putting some 15%. And in the third leg of correction, suppose if you are putting near about, because by this process you have put 60% of your capital. So this process of third deployment, if you are making some 35% of that, so then also your performance will be little different. So that based on your risk appetite, based on your objective, you can think it. So this is how you should do a investment planning using a riskless instrument of liquid and liquid mutual funds and ETFs. But I will not advise to do the similar kind of things in the stocks, because stocks are individually performed counters. Individual stocks performance is very vital. Sometimes the correction in the stock is not a real one. It may be a individual industry related fall is there. And there is a risk associated with this also, because this part of money what you are putting 10-20%, this is in a diversification happening in a risk instrument. So this part of the money is in the high risk instrument. So this part of the money is in the high risk instrument. It may give you a chance to come out quickly if there is a rebound. If there is a consolidation of many months, then also you will be hooked to that particular position. And in that case, your loss in interest will be more as compared to the profit you expect. So that is also one possibility is there. So always thinking in terms of profit, it is not right, but this part of the things also there. Suppose you have come to February, and in this February level itself, market is consolidating till December. So you lost the interest cost on this deployment what you have done. So on December, though it bounced back and goes to this level, but you may not get the return what you could have got in the risk list. But it is as per the emerging market trend. We are an emerging market. So as per the emerging market trend, it is a good choice for a deployment of 10-15% into the ETFs. So this is how you should do your investment planning along with ETFs and along with your liquid funds. So if you have a horizon of 2 to 3 years or 5 years, 3 to 5 years, then this will be a great choice. This diversification will really reward you. It will reward you very nicely, and that reward will be much more than the 8% of annual return what you can get it. Also the monthly trends and other things you can take, and based on that you can decide. I'm not taking any 1SD methods, monthly trend or quarterly trend. Rather, I am just saying that this is only 155% correction I am going to enter. So that is the basis I am for things. And thinking that index will go to zero, it is impossible. Index will never go to zero. If you are, someone is saying that if by this process 55% correction happens and in 20 months the index is finished, then it is a quite ridiculous thought. That thought is not a true thought. Through only for argument's sake, you may say that yes, I have deployed in index. Index you are saying 3 cycle, 5 cycle. If it is continuing for 20 cycles, then index is zero, my money also zero. So in that case, country also will become zero. So that kind of thought is a ridiculous thought. In that case, Even though if that kind of scenario happens, then there will be no country and there will not be any value on your FDs also. No deposit will have a value. So even your FDs also have a risk. If a bank itself is not there, who will pay you back? So that, suppose you have deployed 20,000 rupees on November 9th and 10th November or 11th November itself, again you are getting a chance to deploy. That time I'll advise better do not deploy a second part of your money. So here the rule of the thumb is that whatever the time it has taken from 16th October to 9th November, how many days it has taken to correct by 5%, if in one third of the time, this also comes from a Elliott principle, if less than one third of the time, if it is again correcting to the same extent or more than that, means 100% of retracement, further retracement in the lesser time if it is giving, then better wait for one settle down period. Even though if it bounce back also, do not worry about that. Better wait for one settle down features, and once it settled, then you should deploy your second part of your money. So that is one of the most important thing you have to remember here. So if you are putting in the bank ETFs and other things, that time you will be encountering this kind of situations. To implement any strategic investment planning of your own plan, so that time you must ask that how best I am in understanding the market. Do a self-assessment. How best you are in understanding the market. You have a instrument of Nifty. I have also told you, do not do this, do not ever try to do this deployment in any stock, because stock is a individual industry specific things that may give you a very bad result. If you go for a index, it cannot give you a bad result. Also I have told you, the way we are thinking that 5%, so that is a thing is quite impossible. Then also I have told you one more thing, whenever you deploy your capital, X amount or 10,000 rupees you deploy after a 5% correction. So look into the second deployment. If the second deployment or the second chance you are getting in a very less time, suppose for this correction of 5% it has taken 10 days time, and if the second correction is taking less than 3 days time, means one third of the time it is say taking less than 3 days of time, another 5% correction is happening. I am telling you, do not deploy your second tranche of money, better wait for one stability. So that timing is very, very important. This part is very important. First you put some 10 to 20,000, and immediately after putting your money, within a very lesser time, say this first 5% of correction taken 10 days, the coming 3 days itself it is correcting by 5%, further 5%. In that case I am saying that please wait, do not invest, go for your, wait for one stability, wait for some further more correction, then you think of deploying it. One stable thing will come, some point it has to find a bottom, so just wait for that. You can furthermore improve this thing if you are putting 1 trend forecast for quarterly or monthly, this kind of things. Now question comes, why we fail in the investment planning? Because of greed to make more money and no homework. Greed to earn more money is the cause of our failure in the investment planning. And just I have shown you an assessment of 1 year. Just do this assessment for the 5 years or 10 years. Same the process what I have described here. Same process, 5 to 10 years period, do an assessment and tell me what is the result of the things. Each 1 lakh investment in this particular way for 10 years, how much it has given. So this is called your investment planning. So regarding the smart finance products and services, we have various products here, and the investor scores. Many investment models I have given there in the video course of investor course. So many investment models based on your alpha hedge strategies and other things, I have given many models there. So that too means in that investor course, if you have, you can get those things. And besides that investor course, like you are seeing here, Elliott course, technical analysis, Fibonacci, all these things are there. So those who are buying all these things, all stocks at a time, so they will be getting one hefty discount here. And if you buy individually every course, this you can say some cost you 1,500, some cost you 3,000, like that. If you take all stocks together, you get it at 17,500, which is almost 64% of discount we give here. And so, and you can learn many things on this investor course. Has in video presentations I have given lot many information about the investment portfolios, how to design an investment portfolio, how to choose a stock for the investment, what are the basis of this thing. And in the means many short-term investment, monthly investment, if you are making in choosing a best stock for investment for monthly objective, there also I have in earlier session last time 1 month event also I have given uh, one great method, which videos you can find out wise investment technique here. So some ratios we are using, we are finding out some best stocks out of 2 or 3 stocks and investing. So this method also is a very useful method for choosing a best stock out of a basket of 3 or 5. So this video you can go through if you have time, so that you can learn about how to choose a best stock among a basket of stocks to invest. But today's event what I have taken, it is purely on the investment planning, how you plan, how can set a goal, how you can do a diversification, and how you can get a good return on your investment.